Direct from Foxborough, Massachusetts, the gem of Norfolk County, and taped at the studios of Foxborough Cable Access. It's Foxborough Central, and here's your host, Bob Hickey.
That's right, another great episode of Foxborough Central. I am Bob Hickey, your host. Thank you for taking the time. Sit down, enjoy a half hour with me and my guests. Today we're going to talk about, let's talk about finances, financial planning, interest rates, stock market. Just have a nice discussion. Here to join me are some resident experts. We've got Mark Coletta, who is the branch manager of Rockland Trust here in Foxborough, and also Bill Mahoney. And Bill has many hats. You are actually with Foxborough Cable Access, full disclosure. You assist us with our finances, but what is your official title?
Sure. I'm a financial consultant with Rockland Trust and cover a region that covers Foxborough to Bellingham and down to Attleboro.
Okay, great. So the advice that we're going to talk about today is more just general market information, and for folks at home who are watching, this is just intended to be educational, and what we're trying to do is just give a good feel for what some opportunities are, and particularly in the press lately, there have been some stories about mortgage foreclosures, and if you're paying any attention, the stock market is at historic highs. But how did that happen? How did we get there? I thought we're in the middle of a recession. Let's talk. Mark, first of all,
sure.
Rockland Trust here in Foxborough is like any other bank in that they offer mortgages.
Correct.
And how does that work if I'm coming into the bank and to say, hi, I'd like a mortgage?
That's pretty much exactly how it works. You can come into a Rockland Trust bank at any time or call the 1-800 number and request information about a mortgage or even apply for a mortgage right there at the branch. Myself and the team of mortgage originators at Rockland Trust are on site, able to answer questions in person and have a real conversation with you to see what fits best for you personally.
So, part of mortgages is also refinancing, and then there's reverse mortgages. There's all sorts of different options.
Sure.
Let's talk first about the interest rates today. They're at historic lows.
Correct.
And an incredible time now to, if you're buying a house or if you're refinancing. But why now? Why are the interest rates so low, and will they stay there?
Well, they have ticked up a little bit over the last few months. It's still at or around historic lows, but they were a little bit lower, so they have slowly been coming up a little bit. That trend, based on who you talk to, may continue, but for the time being right now, they are great. It is a great time to buy a home, refinance, take out a home equity. All of those are going to be at rates that you're probably never going to see again in the future. So my advice is to take advantage now.
I know that when I purchased my first home back in the 80s, interest rates were at about 11%. And
yeah.
Right now, I just refinanced that at a great rate, not through Rockland.
It's very disappointing.
But I think what we got was a fantastic rate. But with the different options out there, why are rates so low, and now why are they going back up?
Well, Bill could probably answer the rate conversation a little bit better because it has to do with the bond market. It has to do with a lot of economic indicators that kind of drive down or drive up the rate. So, Mr. Mahoney, if you would like to elaborate.
Sure. Well, I think part of it, Bob, is that, as we know, the Fed has said we're keeping interest rates low.
Yes.
Coming out of the problems of 2007, 2008 in particular, and the Fed's sort of mandate has been we're going to keep rates as low as possible, between 0.25%. That's really what's driven the refinancing boom. Very low rates for what the Fed says an extended period of time.
And when the Fed, and when we're talking about the Fed, we're really talking about the
Federal Reserve Board.
Federal Reserve Board, right? And you hear that they come out with their predictions and how they want to keep interest rates low to drive the economy, and that's essentially what they're doing. Is they're encouraging investment, they're encouraging financing and buying homes by keeping interest rates low.
Right.
So what would prompt them to raise the rates?
Well, part of what they do, what would prompt them to raise rates is to say, you know what, things are improving, right?
So a healthy economy drives
Absolutely.
interest rates.
Sure, and the challenge for the Fed is they want to keep rates low to really encourage two things. One, to encourage growth, to encourage borrowing, in fact, to encourage lending. But what they also want to do is keep those rates low until that time comes when they see the economy start to move. And the Fed right now is saying, we've kind of put a target on employment. We want to see employment move up. When that happens, we can probably expect rates to start to come up.
And the news, and depending upon when this is aired, I just had some wonderful employment news. I think 216,000 jobs are just created, which far exceeded estimates, and unemployment rates are holding steady, or in Massachusetts decreasing a little bit. So this is good news, and this is what the Fed wants to see, I would imagine.
Right, I think that's what the Fed wants to see, but we need to see it for a little while, because I think when you...
One month of recovery doesn't make
No.
it.
Sure, and we've had a few months of pretty good job numbers, but we do have some miles to go, and I think that the Fed has really said to us, it's going to be a while until those numbers are consistently improving and getting better.
So people at home, if they're watching this program, they're saying, oh my goodness, the rates are going to skyrocket to 15%.
Sure.
I'm going to divest, I'm going to jump right into a money market, and I'm going to... You're not saying that. It's not going to happen overnight.
I certainly don't. We don't think that's going to be the case. We think that the Fed is going to, at some point, and there'd be a line out the door, Bob, if we knew exactly when. But we know at some point interest rates have to start to move up. But typically, that's going to start slowly. That's certainly what we'd like. Of course, the concern, particularly in the bond market, is that that could happen very quickly. Because even though the Fed really controls those short-term rates, longer-term interest rates are really, well, they're dictated by the market. So if the market starts to anticipate, one, inflation, two, really an improvement in the economy, we could see our longer-term rates start to move up.
I see. So when the interest rates go up, what does that do to the bond market? Does that make
Sure.
it more attractive, less attractive, up, down?
Right.
How does it work?
Great question. Because really what happens is, I'll use my pen analogy, but
We have very expensive props here at Foxborough
and very
Cable Access.
sophisticated tools.
I like this.
But really what happens when we're talking about a bond is as interest rates go down, the price of bonds you hold go up. Okay? And we can make the case that we've been in that environment, Bob, since the early 80s. Really, you mentioned about when your mortgage was at 11%. Really, since that period of time, with of course some ups and downs along the way, we've been in an environment where rates have gone down and therefore bond prices have gone up. So we'd say we've been in a long-term bull market for bonds. Well, the opposite can happen as well, right? As interest rates start to go up, the price of bonds that you hold today go down. So that may be what's awaiting the bond market. So perhaps you could say the easy money that's been made in the bond market can't continue forever.
Now it's interesting that you say that, because it has been an extended period of strong bond growth. But the world does not remain static, and the stock market and all the components are always cyclical. The economy goes up, the economy goes down. Jobs go up, jobs go down. The housing market goes up, the housing market goes down. Everything is cyclical. And when people say, oh, we're at historic highs or historic lows, well, I would imagine that at some point along the way there have always been historic highs. The 1876 crash. There's just, history has shown that there's always going to be a period of recovery, and there's always going to be a period of adjustment, loss. So as an investor, say I'm coming with my nickel to an investment manager, and I'm saying to myself, how do I protect myself? Is it all in bonds now, and then I should get out of bonds completely? Should I now go into equities completely? Should I just jump right into the stock market with all my money and buy 1,000 shares of Microsoft? What do I do?
Well, I think any extreme, I'm not very exciting, Bob, and as a group we may not be terribly exciting, but what I'd say to you is that diversification is probably the key. And also matching up sort of time frame with the need for that money. So for example, if you have dollars that are going to be used in 3 years to fund education, we probably shouldn't do much of anything other than have it sit in a savings account or in a CD. On the other hand, if it's money for 20 years from now for retirement, boy, that savings account is not the right vehicle. So you hear the folks in our business talk about diversification.
Right.
And you sort of mentioned kind of a couple of extremes. Should we be all in bonds or all in the stock market?
That's what's called throwing a softball.
Thank you very much. We certainly appreciate that. We'll see if I can hit it out of the park.
Okay, I'm sure you can.
Let's at least get it out of the infield. So the thing that diversification that we, again, talk about all the time, what it really means is as much as we'd like everything we own in our portfolio to go up at the same time, we want to avoid the other side, which is that everything in our portfolio going down at the same time. So even with the possibility of rates going up, certainly doesn't mean we shouldn't own any bonds.
Right.
But what it probably does mean is we don't want to put all of our dollars into bonds today. By the same token, we're hitting new records in the stock market. That always gives us a little pause, right?
We are at historic highs, and we've now finally exceeded the certain benchmarks where we were prior to 2008, 2009. Pick whichever you want. Subprime mortgages.
Sure. Lehman.
Yeah, Lehman. Yeah, exactly. So it would seem to be that maybe the stock market is topped out, but I'm hearing that there's still expectation it's going to continue to grow. So it's a tough position for investors to be in, not knowing what to do. But isn't that the stock market in general? You never really know what's going to happen.
I don't think we do. So as a result, what we really want to do is we want to be, again, well diversified. We want to own different sectors. We want to own different segments of the market. And here's what we'd love, of course. We'd love for all of them to work out well. The reality of it is they don't all work out well at the same time. But if what we can do is know we need this money in X amount of time, then we can really build a portfolio that will frankly take advantage of some of the ups and downs in the market.
So if I'm at home and I don't have my subscription to CNBC and I don't have my...
Your life might be just fine without it, frankly.
a Kramer large. But I also don't get my Wall Street Journal, and the financial page of the Boston Globe just puts me to sleep. What are some marks or measures that, listening to WBZ for the 30-second snippet would give me confidence that the stock market, is it jobs, is it interest rates, what is it, GDP going up? I mean, what is it that tells me that, hey, things are going well, it's a bull market, the economy's going great? Sure. What are some of the key measures?
I think one of them is more of our neighbors back at work. Right, so I think that's one of the things.
People earn money, people can spend money.
Sure, and I think that's probably more an economic indicator. The stock market has done very, very well lately. We sometimes forget, we bottomed out around March of 2009. Market's more than doubled since then.
It has, yes.
So that's been wonderful for the stock market. But you know what, if we walk around, it doesn't always feel that wonderful.
And I think that's why the questions, because it doesn't feel like a period of phenomenal growth. It still feels as though people are concerned. I know that interest rates for a savings account are still very, very low. I'm looking at rates. There's an advertisement that said 1.01% for a short-term CD, and that seems very low, but then again, it's much more than what it has been. Is this a trend that's going to continue, or are rates going to kind of stabilize? Or I just guess that the question at large, and I'm not looking for financial advice, but I'm looking for more of an analysis of, so jobs go up, unemployment comes down, interest rates go up?
Well, I don't know that there's a perfect correlation between those two, but I do think that that's what we could anticipate, that as we see these job numbers continue to be stronger and stronger, then the Fed is more likely to sort of, what we say, pull back on some of the easy money that we've had as of late, which means that ultimately short-term rates they could let move up. And so I think that's what's likely to happen. But boy, I certainly wouldn't be in the business of predicting that it's going to happen next week or the week after.
It sounds like just a little bit too much for a guy like me to understand. We're going to toss the next softball question out. There's a lot of different ways that people can manage their money. And you're a certified financial planner?
I am, yes.
Okay.
My wife will tell you certifiable, but I think she means something different.
Well, that's why we didn't invite her on the program today.
That's excellent.
We'll get her in the next program. There are many different types of firms and people that will help manage, but I would assume that the recommendation would be that people get professional assistance to manage estate planning, that sort of thing.
Well, we think obviously the value of a professional is important. Otherwise, Bob, I should find something else to do. But we certainly think that's important. But I will also say there are many good professionals out there doing really, really good work for individuals, for families, for institutions. I think you should avail yourself of those resources. I think probably more than anything, you should know what you're buying. And I simply say that because very often I'll see people come in and say, I have this statement, I've worked for a long period of time with an individual, I don't really know what it is. Boy, if we don't know what it is, we probably shouldn't be buying more of it. So I would say that clearly education is probably the most important element as you're making retirement planning, financial planning decisions. Some of that education you can get on your own, and some of that education, maybe it helps to work with a professional.
You know, and there are many different types of strategies people can get, and we're going to talk now more towards the end of the working career, getting into retirement.
Sure.
You know, with a planner or someone to work on your retirement, you know, doesn't Social Security just take care of us all? I mean, we've paid into Social Security unless you work for the government and taken care of in a different way, but doesn't Social Security just take care of us?
Be nice.
Yeah, isn't it?
Yeah, I mean,
I paid into the system.
I think there's not many people out there banking on Social Security to get them through retirement, and using professionals like Bill to kind of fill in the gaps that Social Security doesn't fill is very important to having a plan for when you do ultimately retire. And that's, comes into a lot of things come into effect as well. Your mortgage, as you talked about, having that in place for when you retire to either expire by then, be completely paid off, or to refinance it to the point where the payment's affordable for you to go into retirement. So I think that you got to take a look at everything in your life when it comes to time to plan your actual retirement. And Bill's, a expert at planning that, and can probably give you some more specific examples.
But with Social Security, you read in the news that Social Security is going to be bankrupt by X number of years, or that there's not going to be enough money to fund it. But how can that be, since we're paying into it, and doesn't Congress sort of borrow against the Social Security reserve? So Social Security itself is not going out of business. It's just that the changes that they can make, such as extending the retirement age, the early retirement age, or your mandatory retirement, or however you want to phrase it, the longer they put that off, then the less of a burden there is for them. But it ends up back-ending the burden because there's still that liability they have. But I guess in the world of Social Security and insurance is I don't want to say the hope, that sounds macabre, but the fewer years you're drawing out of the Social Security system, then the less their outlay is, and so the more money they have to fund future outlays.
Well, I mean, I think when they initially started Social Security, the life expectancy was much lower than it is now. So kind of adjusting for that is something that eventually you'd think that they're going to have to address. And that, based on your analysis of what they're going to do or what you think is right or not, could determine whether it's a solvent program when someone my age retires.
And then with that, as the life expectancy does increase, it's longer and longer, and I'm sure that makes a negative draw on what they're planning to pay out, and so that sometimes causes some stresses on the system also. So with that, I assume that what we're now going to talk about is how to plan to supplement your Social Security to ensure that you have A, a lifestyle that you want in retirement, or B, just the necessities to cover. When should financial planning start?
Well, I want to focus a little on Social Security as well as part of that. When should it start? Well, I think as soon as you decide that a great strategy is spending less than you make, because that's probably the best strategy. and once you decide,
not everybody gets that.
No, I understand. Believe me, we struggle in our own house with that. So I think as early as possible, of course, makes sense to do that.
But I can't afford it now. I'm 22. I'm just starting out. I have no money. I'm living off a credit card. I can't possibly begin to plan for my future.
Yeah, and you know what? For somebody in their mid-20s with those issues that may have student debt, that may have credit card debt that's helped them fund some of their education, which I certainly see all the time. Very often my clients will say, geez, I'd like you to meet with my son or daughter. And you see that. So they probably ought to attack that debt first. Maybe not the student loan debt, because given the rate environment we're in, that may be very, very low. Right? But if there is that credit card debt, that's probably what we want to attack first. But that young person, first job, sort of mid-20s, they need to take a look at a retirement plan that might be available for them at work. They really do.
Because we all know that in our mid-20s we're going to live forever.
Absolutely. But if I can, I want to mention Social Security, you know, and Mark said, boy, you know, you wouldn't count that as your entire retirement for income. But I will tell you, it is a significant chunk of money for most of us, and a really important bit of money. I mean, I may not have the statistics perfect, Bob, but somebody who earned $43,000, $45,000 a year with a non-working spouse, to replace their Social Security income, they need to put aside a pile of about $700,000.
Really?
So Social Security, although it may not be your entire retirement, is a very, very important component.
So it's a significant piece of
It
anybody's.
certainly is.
And we'll call it a portfolio because people are actually paying in. It's a forced retirement plan.
Right. You don't have any choice. You can't opt
Right.
out, right? You can't opt out. But it is, and there are lots of things that people should think about when it comes to claiming benefits, collecting their Social Security. One of them is how early to take it. Very often people say, geez, you know what, maybe I should take it right away at 62 when I can. Well, you're setting yourself up for a permanent reduction in benefit. If you can wait till your full retirement age, which depending on when you were born, 1937 or earlier, we're going to be at 65.
Okay.
Between 1943 and 1954, at 66. Mark's age, 78. I don't know. No, really beyond that, 67 years old.
Okay.
And so your full retirement age is that time when you can get the full benefit that you're entitled to. And if you can wait then until 70, that benefit goes up by 8% every year.
Really?
So sometimes the best use of your money
It's
is
just
actually not collecting Social
right.
Security yet.
Interesting.
So average life expectancy, your best bet. No, I don't know what my life expectancy is going to be like, but I probably, like everything else, going to be about average, right? So if I can wait to take that till at a minimum my full retirement age, that's really what I should do.
So now, as we get up towards the end of our work career and we enter our great retirement career, and hopefully we have our health and we have our family and we have the ability to really enjoy it, we then get into, and you had mentioned earlier about spending less than you take in.
Right.
Which I suppose is a key to anybody's financial success. There's been a lot of talk lately about mortgages and the ease of money. It's sort of a double-edged sword, I would imagine, because now people have overextended, and everybody, I'm sure, is familiar with the tales of people purchasing McMansions, not having the money to furnish their homes, of buying in excess of what their income could reasonably support with a reserve. And then when the job is shipped off overseas or due to contraction, there's a reduction of income. How do we combat this with, hey, interest rates are great low, now it's time to refinance, we want to borrow, the government's encouraging people to borrow, and the government doesn't really have such a strong moral stress test to be able to say, well, yeah, we want you to borrow, but you shouldn't borrow. Who makes these decisions? Who should borrow, who shouldn't? And at what point do you say to yourself, all right, I'm going to stop borrowing because now I want to plan for retirement. I don't want to become overextended.
Well, as far as that problem that we had with people overextending themselves, banks have kind of taken care of a lot of that. They learned from their mistakes over the past 5-10 years. Subprime mortgages. You don't see that happening anymore, at least not as great it was back in 06, 05. But banks will kind of have taken in the reins a little bit as far as who they're lending to. You need to prove your income now. The days of a no doc, no income loan, or stated income loans are kind of gone in the past. So you don't see people overextending as much as you used to. It does still happen, of course. People bite off more than they can chew when they purchase their first home, or if something happens while they're in their home that causes their income to be reduced, then now that mortgage is too much for them. But there's a lot of programs out there that can combat that and help people. And if you're in that situation, go to your bank, talk to them, and see what's out there to help you get through those tough times if that is what you're going through. But banks are kind of regulating themselves at this point to make sure that they're not giving bad loans. People aren't going to have the issues that they had years and years ago.
Interesting. So, and as part of that conversation is also discussion of, okay, how much insurance is too much insurance, not enough insurance? And I know this isn't an insurance discussion, but when you're taking out a significant load of debt or you're planning for your retirement, there's something called replacement income, right? And what does that really mean?
Well, if for insurance purposes, I know speaking for myself, I want to make sure that when I'm gone, my wife can pay for everything that we have currently. So when I go to the insurance agent, they want to look at what my assets are and what my liabilities are and make sure that those are covered when I'm gone. And that's kind of the goal, I guess, when you get into an insurance conversation, is to make sure that the people that you want to look after are completely looked after. And insurance, it's a key part to anybody's portfolio when you're talking about going into retirement, when you're talking about any really financial planning.
Life insurance and disability insurance, because one never knows what could happen.
Sure.
And you, responsibly speaking, it's one of the worst things to leave your family with a debt load. There's a great, I don't know if it's a great program, there's a program that just started on one of the networks about a wife and family who ends up in a real bad situation because, and I know there's drama and it's crime, but I was just thinking more in conversation of daily life. Yeah, what happens when you end up with a lot of liabilities?
Yeah, we're in an environment today where purchasing life insurance has gotten cheaper and cheaper and cheaper. And that's in part because we're living longer and longer and longer.
So the pot of money continues to grow and grow and grow, right?
Correct. So they're really, it's a great time, frankly, to be shopping for life insurance because term insurance rates are as low as they've been in years. And I really would say that, those are some of the foundational financial planning issues. Because everyone would like to say, geez, investing is sometimes more exciting, a bit more sexy to talk about, but it might not be as important as making sure your family is protected.
So you talked earlier about diversification. Yeah. So insurance is part of a responsible portfolio.
I think so. I mean, I think it's certainly an important part of responsible financial planning. Absolutely. And we can do it today, and it can be affordable for that young couple. And I think that's really, really important for people to know. There is a solution to cover that mortgage that you've just taken out. Also to cover, frankly, if you have two 30-year-olds that have just gotten married and they're just having their first child, they probably don't have all the dollars saved they need for retirement. They probably don't have the dollars they need to educate that child.
Right.
They can do it in a very cost-efficient way and cover that.
Fantastic. So I'm a teenager and I'm in high school. In fact, when I was in high school, we had a representative who encouraged us all to go out and get universal life insurance to plan for the future. And I don't know if that's still what people do, but it was...
I would say this is always difficult. I am a big believer, particularly for the young couple who has sort of a large need, in term insurance. The permanent insurance, certainly there's value to it. And certainly there are situations where permanent insurance is absolutely what people should get. But I believe the vast majority of the time, a term insurance policy is less expensive, covers the need for a set period of time. That doesn't mean to say that when permanent insurance is sold that there aren't very good reasons for it. But I would just say that the vast majority of the time we want to get the coverage as cheaply as we can. And there's nothing worse to me than meeting a young couple who, say, has a need for $700,000, $800,000 worth of life insurance, but they come to me and they have a $150,000 whole life policy because that's the premium they could afford.
Right.
Well, instead, maybe using that same premium for a much larger term policy is what makes the most sense.
So as we run out of time, this has been a great discussion. I really want to thank Mark Coletta and Bill Mahoney for coming and having a talk about financial planning and interest rates and mortgages. One thing that strikes me is as we get to the end of our work experience, what if I didn't do such a great job of financial planning? What if I didn't really sock it away? I'm now at the end of my work career. I have my house, I own my house, but what if I'm out of money and I have medical issues and I need to do something drastic to make it till I can stay in my own home until the end? I've heard reverse mortgages. Can you talk about this at all? Or
reverse mortgages, I mean, they're
Is it a good thing? Is it a bad thing?
It's very specific to the individual situation. I mean, it's a very niche product that is only good for specific people in specific circumstances. It's usually considered a last resort for a revenue stream for the individual. There's other areas you can go in. If you own your home outright, you could tap into the equity with a home equity line. You could sell the home and downsize like a lot of people do. But a reverse mortgage is more for you want to stay in your home for the rest of your life, and after that you really don't care what really happens to the home, because at some point it's going to have to be liquidated to pay off the reverse mortgage. So going into that, you have a lot of family considerations to take into. If you want to leave your children the home, it's not a product for you. But you can get a lot of good information if it's something that you want to get a revenue stream from. It could be a good vehicle for you. But I mean, there's a lot of websites out there that have a lot of good information. AARP, they have a question and answer section that really goes through whether it's right for you or not, because it's not right for everybody.
So I guess the final word is that there's no one catch-all way to make money.
Unfortunately,
there's
no
one chunk of advice that you're going to spit out here and we're going to run out to the store and say, hey, there's the money tree, I'm going to grab it.
Like most things in life, it's different for every person. So you really need to have a conversation and dig into your personal situation to determine financially what makes sense in banking, mortgages, retirement, investing. Each person's different.
And as with everything, professional advice is something that probably is not a bad thing, just as we don't diagnose our own cancer and we don't build our own sub-basement.
Exactly.
Also,
I certainly don't.
I definitely
I don't. So anyway, thank you so much for taking the time to come out. Mark Coletta and Bill Mahoney, and you're with Rockland Trust. It is one of the banks here in Foxborough, and this is not an endorsement of any one particular company, but just a great discussion about finances, mortgage rates, interest, and some of the opportunities out there for success or some of the pitfalls for not success. We don't like to say failure, that'd be a negative. I'm Bob Hickey, your host. Thank you so much to all the volunteers at Foxborough Cable Access for helping to put this on, including Betty Travers, Deb Stores behind the cameras, Paul Gukin, and my friend Gary Nash behind the glass, making it all work. Mike Weber, our executive director, who edits this and makes us all look fantastic on the cable channels. If you have an idea your organization would like to be focused on featured on one of our future episodes, please contact Foxborough Cable Access. Our studios are at 28 Central Street here in beautiful downtown Foxborough, Massachusetts. We are at 508-543-4757. Stop on by or check us out online at www.fcatv.org, which is where you can also find all the wonderful past editions of Foxborough Central. I'm Bob Hickey, your host. Thank you for taking a little bit of time. Have a great day, Foxborough.